This is another example where we are looking at a company that is trying to decide whether they're going to change from all equity capital to a capital structure that is 70% equity and 30% debt. They have an 8% interest rate on debt. They have 7,400 shares. Their share price is $55, and their EBIT is expected to never change. Okay, so in this one, we're looking at homegrown equity. So we're actually looking at an individual shareholder who currently owns 100 shares of stock. And this shareholder wants to see what her cash flow is under an equity structure, what it will be like under the new capital structure, and then what she has to do to maintain the cash flows from those shares if they change the capital structure. So we have first, what is the earnings per share? So the earnings per share on the 100 equity firm is the EBIT divided by the shares outstanding. So we don't have interest payments yet. So the cash flow that Melanie is receiving under the current capital structure, they have 100% dividend payment out, is her 100 shares times the current earnings per share. So 100 times $2.82. So with their 100% equity payout, she receives $282.43 every year in dividends. Now what happens if we change that by taking on debt? So first, we need to know what the market value of the firm is. So we have 7,400 shares at $55 per share, giving us a total market value in our equity of 407,000. If we're going to take on 30% debt, that is our equity times 30%. So we're going to take on 30% debt to buy back shares. So the number of shares we're going to buy then depends on the amount of debt divided by the $55 per share price. So we can buy back 2,220 shares. Okay. Then we need to determine what our net income is. So our net income is our earnings before interest and taxes minus our interest payment. So minus the amount of debt that we took on times our interest rate of 8%. So our net income is $11,132. The earnings per share is the net income divided by the shares outstanding. So we had 7,400 shares outstanding, and we bought back 2,220 of them. So now our earnings per share is $2.15. Now we get for our money, for 100 shares, we get $214.90. Question C says, suppose they do take on the new capital structure where they take 30% debt, but Melanie, the shareholder, wants to maintain the same exact cash flow she was getting under their all equity structure. So she wants to unlever her shares of stock to recreate the original capital structure. So how many shares should she sell in order to maintain that income? So she needs to sell 30% of her shares because they took on 30% of debt. So she had 100 and she needs to sell 30% of them, or 30. needs to lend those proceeds at the same interest rate of 8%. So her cash flows from interest would be the $55 she gets for stock times 30 shares of stock that she's selling times the 8% interest rate, or $136. The cash flow she gets from her remaining shares is the $2 earnings per share times her $100 minus, or 100 shares minus 30 shares. So she has 70 shares remaining. We add those together and you should see that the result allows her to maintain the cash flows from A. So we have explain why this company's choice of capital structure is irrelevant. So their company's choice of capital structure is irrelevant because shareholders can create their own results. So they can create their own, it's called homegrown leverage, or unlevering their stock to maintain the payout of any capital structure they want, regardless of what the firm decides. In this example, we have information about their current debt to equity ratio, their weighted average cost of capital, and their cost of debt. We want to know what is the company's cost of equity. So we know that weighted average cost of capital is determined by the cost of debt times the weight of debt and the plus the cost of equity times the weight of the equity. So we can use that information to solve for our cost of equity. So our cost of equity here is our weighted average cost of capital minus, I need some parentheses, weighted average cost of capital minus the cost of debt times, and then we need the weight of the debt. So we have our debt to equity divided by 1 plus the debt to equity times 1 plus the debt to equity. So under our current result with the debt to equity ratio of 1.5, our cost of equity is 15.45%. And so we know that our debt is 1.5 times more than our equity. So then we have each one of these results. We want to know what is our cost of equity under each one of these situations. Okay, so under 3, it equals the weighted average cost of capital. So the cost of, without debt, the weighted average cost of capital is the cost of equity. So we know that it's 9.6% in that case. So what is it if we have a debt to equity of 2, and what is it if we have a debt to equity of 5? So we just repeat the formula from A, where we take the weighted average cost of capital, and we can lock these cells. So we have the weighted average cost of capital, we can lock that one, minus the cost of debt, and we can lock that one because that's not going to change. Only the debt to equity is going to change. Times debt to equity divided by 1 plus the debt to equity times 1 plus the debt to equity. And we can copy that, and we get that at debt to equity of 2, our cost of equity is 17.4%, and that a debt to equity of 0.5, our cost of equity is 11.55%. So that you can see that as a company gets more and more leveraged, the cost of equity increases. Now we're moving into chapter 14 examples. So in chapter 14, we're looking at information about stock dividends. Let me make this question fit on the screen. So first we want to know if we declare a stock dividend, how many shares are going to be distributed as part of that stock dividend, and how will our equity accounts change? So in the first example, we're doing a 10% stock dividend. So we have how many new shares are we going to have? So we have the current common stock divided by our par value times 1 plus the dividend percent. So first we're doing a 10% dividend. The new shares issued, if we take the new shares outstanding minus the current shares, we issue 4,500 new shares. The capital surplus on new shares is the number of new shares issued times the price minus the par value. So remember, what goes in our capital surplus or the additional paid in surplus is everything paid over the par value. So we end up with 184,500. So now the amount that we have on our balance sheet, we will have the number of shares outstanding times par in our common stock. Our capital surplus will be previous capital surplus plus the capital surplus on new shares. Our retained earnings is going to decrease because we decrease retained earnings when we pay any kind of dividend, but our total equity doesn't change. So we can use our total equity minus the common stock and the capital surplus to calculate what the new retained earnings is. B is exactly the same, except in this case, we're issuing a 25% stock dividend. So the new number of shares outstanding is our shares divided by par times 1 plus the 25% dividend. The number issued then is the new shares outstanding minus the existing shares outstanding. And our capital surplus on those shares is the number of shares issued times price minus par. And now we have the same setup. So we have common stock. What is in our common stock on our balance sheet is the number of shares outstanding times par. In our capital surplus, we have the previous capital surplus plus the additions to capital surplus on the new shares. And we know that the value of our equity does not change, so our retained earnings is going to decrease. So the total equity minus common stock minus our surplus equals what is remaining in our retained earnings.